Speriamo che sia solo speriamo.
No, but I was just
It doesn't matter whether you're
Anche qua lui era 150 di piace, ma questo just a big bang. Syndicated work. Yes.
you can have my deposit from my apartment security. Yeah. Probably doesn't trust you. He would trust me. He would be like, yeah, take my money, I don't want to do it myself. You do it. I don't know, I feel like with analysis, it should touch on the fact that more I kind of like those concepts before.
Yes, speaking.
This is an
Is that battery actually dropping?
I'm trying to do my notes in a way so I can print them all.
Is that alright? Okay, thank you very much. Thank you.
I'm going to do it. Yeah, because that's what I usually did back home, like using, I used to actually and then just new messages, and then I've never tried it. I've never written anything in my head.
It seems like it's only between that one.
Se tu metti dentro praticamente quello che tu dovresti dare a qualcuno, io dovrei dare il lavoro e invece ci deve lezione. E come si sta levando? Tu devi dare i soldi, ti devi fare che nazione.
So the last time we met, I think the next day I quickly put together these notes whilst it was still sort of fresh in my mind. So that's why you'll notice I keep on referring to yesterday. Anyway, so the idea is to what's going on here? It looks like the microphone is working. So the idea is to sort of conclude some of our discussions on the subject of distributions. You would have noticed that some of the workings I supplied in 704 I deal with here today, and the idea basically is to illustrate the difference between the treatment of public and private companies. You would recall that I did say that it's not very clear in the books, and certainly when you look at the statute, it's not very clear, and I think it's important to be aware of it.
Is it possible to turn off the microphone? Your sound voice echoes.
Yeah, okay, let me. Is it better? Okay, now? I wonder what's. Okay, let me. I hope it's not me. Okay.
Yeah.
Oh, okay. So I wondered what was going on. It was from my iPad then. So, okay. Yeah, it was a bit disconcerting. I was trying to get used to it. Yeah, so very quickly, I just want to say a few things about some outstanding issues. You'd have noticed from your seminar sheet, Section 836 of the Companies Act basically says that the distribution has to be justified by the relevant accounts. And that's important because it then means that we have to be prepared to look at the company's financial documents to have a sense of the company's profits, its losses, liabilities, provisions made by the company, and of course share capital and reserves. And when you look, if you look at the profit statement, is usually not apparent on the face of it whether a particular head of profit has been realized. So it does require some digging deep to sort of have a sense. I mean, but the general thing I would do initially would be you'd look at the net asset position of the company and try to sort of compare that figure to the capital accounts and the reserves, at least as a starting point. I wouldn't proceed to advise on the payment of a dividend with that, but it would give me an idea of the company's position, right? So so you take the net asset position, right? So the bottom line, and you then, in a sense, hopefully subtract the capital accounts, i.e. share capital and reserves. So we've talked about two reserves, the share premium account and the capital redemption reserve. And if you subtract it and there's a good buffer, then it's a clue, it's an indication that the company does have enough space, enough buffer. But still, I would say you need to sort of dig deeply a bit. And this could arise in different areas. I think the last time we spoke, I talked about a situation where a company needed to post security for cost, and we had to literally look into the company's financial statements to even deal with a note on the accounts dealing with cash and cash equivalents, which normally people think should be readily available. But we then discovered that what was described as cash equivalent had actually been, in a sense, blocked somewhat. So, okay. Now, the other point to bear in mind is that when the Companies Act in 836 talks about the distribution being justified by available accounts, which I've just mentioned, it's not referring to group accounts. It's not referring to group accounts. The determination of profits available for the purpose is really a determination you make at the level of the company, not the group. And in one of the cases, I think if you look at the Nethercoat case, there was an argument about there being profits within the group to which the parent company could, in a sense, reach. So the parent company could tell the subsidiary to pay some money to it upstream. And there was no argument about that, but the court basically said that you could not declare a dividend on the basis of money in a group. So the assessment has to be at the level of the company. Then the other thing to bear in mind is that if it says that it has to be justified by available accounts, then it therefore means that your accounts should not be qualified, and if it's qualified, there should be a statement of non-materiality. If your accounts do not give a true and fair view, then you're going to have problems. And remember, the consequences of an unlawful payment are pretty severe, and I think I did mention that last time we met. So always bear that in mind, and there are quite a number of cases under this head because this tends to sort of catch people out. I'm talking about in practice, and in terms of examination questions, sometimes we test it We tested by, you know, making it really clear that the accounts do not give a true and fair view, right? So the signals are there. So if the accounts do not give a true and fair view, and you see lots of cash, it doesn't mean that the company can lawfully make that distribution. So that's one way to look at it. Then what else? We've talked about distribution in kind. You know, I remember I spent some time on this when I talked about the whole business of the photograph, so the painting within the company group. And so if you look at your seminar sheets, you'll see that we talk about the change brought about by the 2006 Act, which basically allows an intercompany distribution, or rather an intercompany transfer of assets at book value, so long as you have distributable profits, right? So in other words, what the new change has done is to get rid of the common law. Remember, just to refresh your memories, the common law basically said any transfer is blocked, right? And we're not concerned with how much profit you have. You didn't pay a dividend, right? So that gateway is blocked. So any transfer is blocked. Whereas the reform to the Evelyn Bafford case in the 2006 Act, which is on your seminar sheet, essentially says that, well, you can make a transfer within a company group structure, so so long as the company has enough distributable profits and it's recorded at book value. Then, in terms of the consequences of an unlawful distribution, I did give you some notes on the Holland case. That's a case which proceeds with many names. It's called Repaycheck or Re-Holland. You might want to just look at that, where the court basically, you're looking like you can't recognize it. It's on your seminar sheet. I did make a summary of it on the key points. It's a long case, and I didn't want you to sort of waste time reading the bits dealing with de facto directors and shadow directors. So what the court basically is saying is that as regards the liability of the shareholder, there is none, unless the shareholder receives the dividend with notice. Sometimes we test this in an exam by giving you enough information to suggest that the shareholder has a notice, in which case then the shareholder clearly has to return it, right? But in most cases the shareholder would not have notice. The people who are really liable are the directors, right? And it's a strict liability, right? So you have to essentially return it. So if you look at the Holland case, cases like It's a Wrap, right? It's a Wrap, and that's on the seminar sheet. Cases like Towers and African Tug, right? Towers and African Tug was decided many, many years ago, and that basically sort of set the scene. The liability of the directors is pretty clear, there's in fact, all those cases, they're really important. I wish you could, yes, I've given you the Holland case, which captures the jurisprudence, but just read Bastow, for instance, right? Bastow is an interesting case. If you read Bastow, it just reaffirms this and provides a factual basis or context which makes it a bit more interesting. So there's the Bastow case. There is Towers and African Talk. There's Precision Dippings. There's the I think those are basically the cases, right? Okay. So now what I want to do today is just go over the distribution issue. Remember, the idea basically is to just kind of work out how the realized asset test interfaces with the net assets test, right? And I don't know if you did check this out, but if you read any of the books, if you read your sort of standard company law textbooks, they just talk about the two tests. And yes, it's very easy to repeat, but if you think about it, the very first test, the realized profits test, what does that tell us? Profit. It's not saying capital. Profit. It's saying you make a distribution from profit. So the word realized profits test automatically signals to us that you don't touch capital. So if we stop at that point, you then ask, so why do we need another test telling us that you do not touch capital, when we already know that you don't touch capital, right? That's really the point. You get it. And so we then went to the relevant provision, which says do not touch capital, and it began to identify undistributable reserves, which apply to public and private companies. And so I then zeroed in on the relevant bit, which really is the issue. Now, because I thought that's not too clear, so it's not treated in a very clear way, most textbook writers sort of gloss over it. Personally, I wonder whether they understand it. So because of that, I thought, okay, maybe the best way to do this is to sort of break it down with these notes and then look at those figures. So we start here with what I said earlier. The question of whether profit is distributable is done at the individual company level, not at group level. Right? And, we know now that whether profits are available for distribution is a cumulative one, right? Because we look at the accumulated realized profits. And then we also know, and this other point is really important, because sometimes you look at the statutory framework and you say, okay, the directors can pay. But what if it jeopardizes solvency, right? So you could actually be liable for paying a dividend when you pass these tests. Do you get it? Right? So the fact that you satisfy these tests does not mean you should necessarily pay a dividend. You need to ask the question, will this jeopardize solvency? It's a point that has not been, again, very well, and I can see why people kind of focus mainly on the statutory rules, because that's what statute is laid down, and that's the big thing. But it's interesting, if you look at the Urgent Issues Task Force document written by the accountants, they flagged this point up. And if you look at some of the new cases like Risakwana, this point is also flagged up. So I would say that you need to comply with this. So whether a company can make a distribution is a matter for directors to consider. They need to consider their fiduciary duties to ensure that solvency is not jeopardized, right? So again, that's something that could easily be tested. Then we look at section 830, and then I then pointed out the further statutory restriction relevant to public companies 831, and hopefully by now it is clear to you what the issue is. But for those who are still unclear, the real issue is this, right? This bit here. I said it gives us the problem that it gives us the impression that it's a test which only applies to public companies, which truly it is. But when you begin to sort of unpack it, you see that the relevant accounts relevant to public and private companies. So we essentially need to consider head C, right? So essentially, we're talking about net unrealized loss reserve. So, what is an unrealized loss? An unrealized loss basically is, you imagine you have shares, and the share price falls. It's an unrealized loss. You've not realized it. You've not sold it. So it's the opposite of an unrealized profit, right? An unrealized profit would be a valuation, right? So you value some property on paper, so you create a paper profit. So likewise, an unrealized loss is a paper loss. And what Section 831 basically requires us to do is take account of net unrealized losses in the context of a public company. In other words, you look at the balance sheet of the income statement of the public company and say, okay, how much unrealized profits were made, which normally we do not consider, and how much unrealized losses were made. Right? Normally, the accounting rules that the presumption is that every loss is a realized loss, right? So so if you're going to treat something as an unrealized loss, there must be a clear reason. And I'm just giving you an example, right? And then the difference between those two figures would be the net unrealized loss, right? Which, in the case of a public company, you need to take account of. That's it, right? Okay, and so here, I basically break it down. So here, essentially, I imagine a company with a share capital, right, of £1,000, and the company makes an unrealized profit of 150. Now we know, right? Under the common law, cases like Dimbula, you could distribute an unrealized profit, but we clearly cannot distribute an unrealized profit, right? No company can do that. Now, in the example, the company has no unrealized losses, right? So I'm referring to the company in the first column. So no unrealized losses. Its net profit, so its net realized profit amounts to £300. And you'll notice here, I break it down, I explain. So here, that's, right? So essentially, what this is the difference between the realized profits and realized losses, right? Okay. And so we have a treasury box at the end. And remember, the treasury box is the sum total of everything. That's why we use the treasury box. So in other words, it's share capital, it's reserves, and your profits. So if you look at the treasury box here, for column 1, you see that it has 1,450. And how did we get that? We did this. So we're adding a share capital, right? Every profit, including the unrealized profit, right? It's just that it's not distributable, right? And then you also have realized profits, right? You have realized profits. And then you deduct from that your unrealized losses, right? And your realized, and of course you have the G head, which is your realized losses, right? So that gives us 1,450 at the end of the day. So the question is, if you look at the balance sheet and you see 1,450, what is distributable in this case? What is distributable? Now, obviously, if it's a private company, the law is you simply distribute the realized profits. Simple. Right? So that's all you do. You just look at realized profits. So it's very simple with a private company. You just go to column to F here, and you distribute the 300. Right? And remember, we know what the net assets is. Net assets. Remember, I said earlier that if I were to sort of advise a company, I would obviously look at net assets. Right? I look at the figure, what's net assets. Then I look at share capital and reserves. Remember, that's how I put it, share capital and reserves. And I compare the two. So remember, it was a rule of thumb. I said if I were to advise, at least the starting point would be to say, what's net assets? We get the figure. And then I say, which is the 1,450 here. And then I said, how much is your share capital and reserves, i.e. legal capital? Right? And obviously, if that is less than your net assets, then it means you have a buffer. Then potentially means it's just, you can distribute, right? But obviously, if you really want to get into it, you then have to work out precisely what it is you can distribute. Because the fact that you see a profit, it doesn't tell us anything. We need to find out whether or not that profit is realized. In this example, we know that the profit is realized, and therefore that's why we can distribute 300, right? Now, on the other hand, if you take, say, column 3, where you have a public company, here you notice that what has changed here is that realized losses are heavy, right? So we have realized losses of £120, And then we also have unrealized losses of £200. And essentially, with a PLC, you need to take account of the net unrealized losses. In other words, you need to take account of E, right? So you deduct you deduct your unrealized profits from unrealized losses, as I earlier explained, and that's what we're doing here. If you notice here, we simply subtract B from C. So that is the figure you take account of, and because of this, that's the real difference, and I think I explained it further down. That's really what changes everything. So I said, here, but look at the company's three net unrealized loss of £50 and how it affects its distributable profits. If the company is a public company, it can only distribute £130, not the 180. Right? If it was a private company, it would be able to distribute 180. But because it has to take account of net unrealized losses, it can only distribute less. And that's essentially the difference between a public and private company. Right? Then the other point I mentioned is the buyback. So it's very easy to say, okay, you do a PCP. What exactly does a PCP entail? Remember, we talked about buying back shares, and I said a public company cannot buy back its shares from capital. It has to be from distributable profits, right, or the proceeds of a fresh issue, i.e. a replacement of some shareholders with others, right? That's a public company, tight rules. But then I said a private company obviously has tighter, looser rules, right? Because we've always known this with private companies, even when it comes to raising capital. So I did say that private companies are allowed to do what they call a PCP. And again, if you look at the law, you simply see where it talks about it. PCP. But exactly what does it mean? How does it work? And I thought the best way to do this is to explain it. So here, we're considering a company with a share capital of 5,000. It has a share premium account of 400. And then it makes a distributable profit of £50. Now, this company wishes to buy back shares. So the shares were issued at 1,000, but the price itself that the company wants to buy them back is 1,100. So really, it's going to hand over 1,100, right? And the company only has a profit of 50, right? And now what it has done is it has done a fresh issue, which has brought 850, but still that doesn't solve the problem. There's still a deficit, right? And if you just do the mental arithmetic, you'll know that they're eating into capital, right, to the tune of £200. And that eating into capital is the permissible capital payment. So what I do here is show the workings and also show the balance sheet pre and post. And how, by the way, if you look at the balance sheet pre and post, you'll see that I distributed, I'll explain this when we go there, but I distributed between the share premium account and the share capital account. There's no rule that you have to do it. I knew that would confuse you, so I thought I'd better quickly point it out. Right? But I thought it was also useful to do. I'll get there in a minute. So let's quickly look at this. So this is all straightforward. So share capital, £5,000, and then share premium account for 400, distributable profits 50, the nominal value of the shares 1,000, and then it wants to buy it back at a premium of £100, and the proceeds of a fresh issue will be 850. And then so the purchase price is this. Clearly the cost of it, so you're basically funding it from a price of fresh issue, which is 850, and then 50, which is 900, right? But meanwhile, you're paying 1,100, and you only have 900, right? So you've clearly eaten into capital, right? And that eating into capital is the PCP. So the question then is, how do you then show it later on? So if you look at the position before, you'll see that net assets, right? So before, your net assets were 5,450. Because you remember I said net assets, the treasury box, the company raised called up capital of 5,000, right? Remember? And then there was the share premium account of 400, and the company made a profit of 50, right? So that's net assets, right? So 5,400. In fact, it's all broken down there. And then after, you discover that clearly you've eaten into it by 200. So you'll notice here that the share capital has gone down, right? We've simply taken it down to 4,850, and then the share premium 350. Now, it doesn't really follow. The key thing is you reflect it in your capital accounts one way or the other. So notice here I say that we have charged this reduction to the share capital account and share premium account, right? So there's no law as to how you do it, right? The most important thing is that you reflect it, right? And all that. But so you can see now, before and after, that you've clearly eaten into capital. In the context of a private company, that this will not be. So in the context of a public company, this will not work. Now, so let's look at the problem questions. I take it. I can see that there's much interest in the problem questions. So now, here you have Delta PLC. That's important. So yeah, please.
Just to be clear, like the last example, I could take the 200 out of the share premium account completely, right?
Yeah. So exactly. So, because you can charge it to any capital account,
Okay.
right? So that's the point. You can charge it to any capital account, and all we've just done is just distribute it, right? The key things at the end of the day, the figures. Remember, legal capital will always be the same, right? Because remember, when we talk about legal capital, we'll look at your called-up capital plus your undistributed reserves, i.e. the other capital accounts. So I don't make a distinction, right, between them. And that's the point I tried to sort of instill in you at the very, very beginning. That's why I came up with the idea of legal capital. You see, it doesn't really matter. The key thing is that it's the yardstick. And that's why at the beginning, in order to make a distribution, I said that I would look at the net asset position of the company, i.e. what is on ground, and then ask myself the question, what is legal capital? So you identify the share capital and any undistributed reserve, and then the balance is the buffer that you can distribute, subject to the precise rules on realizability and all that, which, by the way, is about convertibility to cash. Do you see? So you don't sort of. Assume a company engages in counter trade, right? You engage in counter trade. How do you work out what a realized profit is? So a company sells barrels of oil, and it gets other equipment back. What is a realized profit? So that's where that document issued by the accountants is important. I mean, important in practice, not necessarily for exams. Yeah.
In this, you said it would not fly if it was a public company, but...
Sorry?
You said this example would not fly if it was a public company, but would it if it was a private?
No, this is a...
Into capital, right?
But that's the point. That's the point. You just nailed it. But you nailed it, but with surprise. There should be no surprise, in the sense that it's the whole point of the exercise is to show you that private companies are allowed to eat into capital. That's why it's called a PCP, a permissible capital payment. They are actually paying from capital. It is allowed. There's no PCP with a public company. You get it?
So it's because of the special form of PCP that you're allowed?
Because of the private company. So we go back, not because of the PCP, because it's a private company. Let me put it this. Let me explain it. I can see you just to clarify. So my point basically is this: at the point where you're raising capital, and when you're taking things out of the treasury, the interests of shareholders and creditors are adverse, right? They're opposite, and left to creditors will have real strong rules, which basically will compel you to load the treasury and also prevent you from taking anything until every creditor has been paid, right? Now, the law hasn't done this. What the law has simply done is to say, well, we will impose tight rules for public companies, but light rules for private companies. So with private companies, we know that the rules are light. So that's why you can buy your shares with a non-cash asset without any kind of valuation in a private company, right? That's the pay-in side, right? I'm just giving that example. You can pay for your shares with the non-cash consideration, without any kind of valuation. On the other hand, you can also take things out even if it is part of capital, right? i.e. the PCP, the permissible capital payment. You can do that. Now, the creditors understand this. I mean, if you decide to deal with a private company, right, then you should be taken to understand this. And that's why any creditor who deals with a private company would want to take a guarantee from the directors or the shareholders, right? That's what you'll be doing. You want to take a guarantee. Do you see?
I'm just confused before when we talked about section 831, we talked about how we already knew all the stuff in litra A, B, and D, which also applied to private companies, which were that you could not take from share premium. And so I'm just confused.
Yeah. I see your point. But there's no need for the confusion. You're conflating two things which should not be conflated. 831 deals with the distribution question, right? In the sense of deciding on how much dividends can be paid. 831 is about the payment of a dividend, right? So what 831 does is to give us rules to measure, right? Now, on the other hand, what we're dealing with here is, yes, it's a return. I agree with you. It's a return, and that's the source of the confusion. But it is not the payment of a dividend, right? So we're not applying those rules which measure the payment of a dividend. So here we're simply doing a return. So if we're doing a return to the shareholders through a share buyback, then the law, whether we like it or not, has allowed private companies to eat into capital.
Makes sense.
Yeah. If you put it that way, yeah. So that's the point. Yeah.
In this exercise, the share premium payable was only 100.
No. So this was the premium on redemption, not the initial premium. So the initial premium, right? We don't even know if it's a premium, but we have to assume it is, right? Because they set up a share premium account for £400, isn't it? Right. So they issued shares at 5,000, and then there was a premium for. We have to assume it's a premium, 400. So it went into the share premium account, right? The reason why I say we don't know if it's a premium, what if it was a sort of a payment of a contribution by a shareholder who did not take shares? Right? Where would we put it? We've got to put it in a share premium account. Remember the Privy Council, right? Okay, so we put that there. So that's why there's 5,400. Now, that's the capital yardstick. What they are now doing is, buying back shares at a premium. That's a different idea. All right, so for that purpose, all we just need to do is work out how much is flowing out of the company. So I'm not, if you notice, I didn't focus on the 1,000. I focused on the price plus premium. How much is flowing out, right? And then I asked myself, can we fund it from distributable profits? No. Can we fund it from the proceeds of the first issue plus distributable profits? Partially, but still there's a deficit. Where does that deficit, where do we fund that deficit from, right? It must come from somewhere, and there must be capital, and that's your PCP. Okay. Yeah.
The aspect was that you can only use up to like 450 in this case.
You said, sorry?
That you can only use up to 450 pounds in this case, that you cannot like eat into the share capital, but only the share premium.
No, you can. You can eat beyond. Now, obviously, this is where a number of things. You remember the law that we talked about? Directors have to consider solvency. All these things will kick in, right? So the fact that you can eat into PCP doesn't. Sorry, the fact that you can eat into capital doesn't mean you wipe out your capital, right? Yeah. So there is, yeah.
Just a quick question. You mentioned something about the guarantee for the creditors. So what does the guarantee want? Is that for people to distribute this profit and eat into the...
No. What I meant by a guarantee was that I was just trying to. I mean, remember, he was expressing some degree of astonishment about the lax nature of the rules for private companies, and rightly so. And I said, and that's why if I'm a creditor dealing with a private company, I probably would ask them, if I see the MD, drive an S-Class, I'd say, do you want to give me a guarantee? Right? Simple. That's because the distributive process is protean, and given shareholders, directors, control of the corporate treasury is almost like giving a bone to a dog. They have an incentive to make distributions, and they're also creative. And the distributive process is protean. There are many ways you can get things out. So the best way to protect me is not to rely on these mediocre rules, right? But rather to get some kind of guarantee. That's what the point I had in mind. Okay. Yeah. I can see you guys don't love problem questions. No, I'm just joking.
Is the PCP generally a capital reduction then? And when
Yeah, it is. It is.
Okay.
Yeah, it is. In fact, I'm happy you put it that way because I was writing my seminar notes for the next class, and that's how I put it in a provocative way. And so I was dealing with capital reduction, and I started with the PCP as, normally people don't describe it that way, but technically it is. If you think about it, it is.
So
Yeah.
do we need to change the articles of association as well? When you do this?
Well, no, because you're not changing the par value of the shares. Do you see? You see, normally, I see your point. When you do a sort of restructuring in any kind of, so take the Oregon case that we talked about last time, where they had to do the subdivision and consolidation, the consolidation of the deferred shares and the subdivision. They needed to change the articles because the par value had come down. If you remember, my memory serves me well, I think the par value initially was 0.1, but they had moved it down to 0.01 for the ordinary shares, and then the deferred shares was 0.9, which were then consolidated. So because of the change of the par value, that's why you needed to take that step. But if you're not changing par value, the only thing you would do actually would be you need to file a statement of capital. So it's a very good question. And this has caused a lot of people a lot of problems in practice. The Law Society actually did a document on this. And the government actually had to consult on this because you now have an obligation to file a statement of capital that in a sense, provides a lot of light on your capital accounts, and the profession has not really been that clued up. Right? If you think about it, think about all the company law, all the companies around, most companies in the country are private companies, right? And how many of them can actually get solid advice? I mean, you guys go to work for Clifford Chance and Freshfields and all that. You don't sort of service, the high streets and all that. It's not. I don't think the guys in the Citizens Advice Bureau would be the ones to tell them about that. But anyway, who knows? You might you might go and work for Citizens Advice Bureau and help. I was talking to, I'm digressing now. I was just talking to my wife. Everybody's been going crazy about this Michelle Obama's book. Which, I just thought, why can people waste their money? But anyway, and I thought, I found it really interesting that, he went to, he left Harvard and went to be a community organizer. Because it wasn't so clear he was going to be president, and I just kind of wondered the choices people make, i.e. partners make in that context. So who knows, maybe she'll write about that, whether she was fighting him. Why? Are you mad? After Harvard going to work for a community organizer? Anyway, I digress. I'm just too much of a realist. Anyway, so yeah. Let's look at this. Some of the points we talked about have just come up. Remember I was talking about public-private companies, and here, when you're dealing with a question like this, always ask the question, am I dealing with a public company or a private company? And even if you start out with a private company, read it carefully, because the question could indicate that the private company actually changed at some point and became public. And if that's the case, then it then follows that you need to apply different rules. So there are many questions where it starts out as a private, and then later it changes to public. So, so here we have Delta PLC. We have Delta PLC, and it has a called-up capital. Sorry, what's going on? It has a called-up capital of 5 million, and a share premium account of 2 million. So I suppose at this point it's pretty clear what legal capital is. And then it says a recent valuation valued the shares of the company at £5 a share, although the par value is £1. So the company is presently a profit-making venture, although it has large accumulated losses, which prevent it from paying dividends. So although the company is making profits, remember the test requires us to look at the cumulative position, so it's being weighed down. So the board of directors wish to restructure its balance sheet so as to wipe out the accumulated losses and to enter into certain equity and debt transactions. Now, in regard to wiping out accumulated losses, we've not dealt with that. That's something we're going to deal with. And you'll see that there are structures in place that we can use to wipe out accumulated losses, therefore to increase your prospects of paying a dividend, right? So, for instance, the reduction of capital, and so we're going to talk about that. But the reason the reason you have this question is because of these other bits. So here it's saying that you want to forge these strategic links with suppliers. You want to give them a stake in Delta, even though these guys have financial difficulties and therefore they can't pay for their shares. So that may prevent each of them from paying for their shares. That's important. So it says that 10,000 ordinary shares are to be issued at a price of £2 to Zaza. Zaza, let's just stop here. Is there a problem with this?
No.
Yeah, but okay.
It's under the market price.
Yeah, but the market price is 5. Why are you issuing it at 2?
Marketing decisions related to the head of
Yeah. So
purpose of forging strategic links.
so basically, your point is that the directors, so long as the directors have made an assessment, because if you look further down, they also issue some shares at £3, right? So so the question is, have the directors considered this carefully, right? Yeah. Okay. And obviously it does not implicate the power rule, right? That's the most important thing. You'd be surprised. People make mistakes and say that somehow the whole power thing is relevant. It is not relevant, please, right? So I'm happy nobody's making that mistake here. Okay, and then the other bit here is that it's saying that Zaza will not advance any payment for the shares in respect, since Delta owes it £20,000. What do you think? Is that fine?
I think so.
What's the general position though?
When you take a share, you have to pay for the share, or you have to take an undertaking to make an undertaking to pay for those shares. You cannot compensate the issue with persistent
Yeah.
credit you had. So otherwise,
Section 583.
Yeah. What does 583 say?
There is a list of, the ways you can pay.
Yeah.
shares.
Yeah.
and there is no
Yeah.
compensation.
Yeah. That's entirely correct. So if you notice, it basically says what 583 says is the definition of cash, payment in cash, and essentially, what it really says here is that if the directors, in a sense, release a liquidated claim, liability for a liquidated claim, then that would be regarded as payment in cash. Because if you remember, the company actually owes its, so not the directors, if the person paying releases that debt, then the liability, then that would be regarded as payment in cash. Do you think this would depend on whether or not the company is public or private? Yeah. Yeah. Okay. So that's fine. And then if you look at the other one, it says 10,000 shares to be issued at a price of £3 to Carbon Limited. Carbon cannot pay for the shares, but it's prepared to give Delta an undertaking to pay £33,000 for the shares at the expiration of 6 years. It's okay, also. Sorry.
Oh, sorry, but it wouldn't, it's under a prohibition that it had to be less than 5 years. The undertaking could not exceed 5 years.
Yeah, it's okay. So again, if you go back to the section you mentioned, 583, if you look at paragraph D, you'll see that. Notice it's defining payment in cash. It's defining payment in cash. So this is when we're not at the point of talking about a long-term undertaking, because if it defines it, if what you're doing is payment in cash, then it's not a long-term undertaking, right? So if you notice, if you look at that section, it starts by talking about cash, what exactly cash means. Then it goes a stage further to talk about what we dealt with earlier, the release, right, of this liability. And then it goes a stage further to talk about this undertaking to pay cash in the future as constituting cash. So if the undertaking to pay cash in the future is regarded as cash payment, then it falls within this head. All right? It's not, yeah. I saw you look at, is it clear? Okay, because I thought you were not too sure. Okay. Now, but then they're paying 33,000. How are we going to account for these shares? Because I'm sure if you look further down, it will tell you to do the balance sheet adjustments and all that. So what do you do? How do you account for it? Yeah.
In relation to the first one, did you say that was permitted or not?
Sorry?
Is it permitted or not, the first one?
The first one? Yeah, it's permitted.
I thought you said it's not.
Yeah.
Sorry?
I thought you said it's not.
The first one?
Yeah.
No, I didn't say that. Did I say that?
I think somebody said it wasn't, and then you went to amend.
No, I didn't.
Yeah.
No, oh, sorry, I didn't. Well, I didn't. No, it's the same section,
Yeah.
right? And I said that, so it says, you're not going to advance any payment because Delta owes you 20,000. The release, right, of this claim for this liquidated debt is payment in cash under 583.
Yeah, no, I thought that.
Yeah, no. Sorry. Well, I'm happy you pointed it out. So, and then I went on to say, then I went on to say that the same section deals with the next one under a different head, right? But then for the two, you'll need to also think about the accounting treatment, because each one has a par value, right? There's a par value of £1. Yet here it is issued for £2. Right, so there'll be £1 to the share capital account and then another £1 to the share premium account. And likewise with the other one that is issued at a price of £3, right? So you'll need to credit the share premium account, right? Because you can only put the par value in the share capital account, right? And that's important because as you're doing it, you want to keep track of the share capital account and the share premium account, because we don't know what's going to be somewhere what's going to be at the bottom. What if they tell us they want to pay a dividend? You need to keep track of your capital accounts in order to work out whether or not they can pay a dividend. So I hope somebody's doing the calculation, right? So to our bookkeeper to do it, right? And then if you then look at 3, a loan is to be made by Delta to Xenon Limited, a supplier of resins, for the purpose of putting Xenon in funds to buy convertible bonds, which were issued in 2003 by Delta to an investor that now wishes to sell them. Each bond has a face value of 80p, although it is said to be convertible into Delta's ordinary shares at the par value of the shares. So a loan is to be made by Delta to Xenon. Xenon would then use this loan to buy convertible bonds, right? And even though the convertible bonds have a face value of 80p, it can be converted into the shares at par value. What do you think?
Recall the monthly versus profit contained.
Yeah.
So it's not permissible. So you can issue the ventures at a lower price than the par value, but once you have to convert the ventures.
Well, it depends on when it was issued, though, because of the fact. Remember the dispute or the area of controversy in the Coventine Mines case between Cozy Harden and where he says never say never, because the reason why that failed was that the issue there was immediately convertible, right? But if you consider the time value of money and all, do you see? So if it's issued way before, right, it may not necessarily be a problem. Do you get it? You see, in that case, you issue it now, and yeah. Whereas if you issue something years before, there's the time value of money. There's so many things, right, that you need to consider. So that's why the judge said never say never, and I remember flagging that up. But so that's one issue, right? So if we scale that, then I suppose there's no problem. But then there's the other issue, though, which is the law on financial assistance, which we're going to be talking about, because that comes up a lot in transactions. It's always a good checklist to have it on your checklist, rather. If you're doing any transaction, to have this point about is there unlawful financial assistance? It comes up in so many areas. It's unreal. It creates a lot of problems for people. So it's always good, no matter how complicated the structure is or how simple, always just make sure you address that as a separate question. Here, we're talking about pain, but do you think, well, you've not dealt with it, unlawful financial assistance. But basically, the law says it's unlawful for a public company to give financial assistance for the purchase of its shares, right? The problem here is that convertible securities are not shares. They're not shares. So for you to conclude that unlawful financial assistance is involved, you'll need to convince the court that this has been done deliberately, right? But on the face of it, a convertible bond is not a share, right? There's some Australian case where they dealt with this, and they'd say, well, there could be unlawful financial assistance, but I think ultimately it would really depend on the facts, right? If the court takes the view that really what you're trying to do is drive a coach and horses through the provision, right, by using this expediency, then they will block you. But I don't think they'll just block you nilly-willy, right? So I'm happy you mentioned the mostly in Covington Mines case. Now, when we go further down,
sorry, would you argue that now that the loan is given with the purpose to buy the convertible, that we don't run into the problem of issuing under par?
Yeah, I personally would say that this would flout the rules on financial assistance. So I'm not dealing with not the convertible bit, right? My analysis of the mostly incompetent minds case, I think, will hold, but I think you will struggle with financial assistance here, and the reason I say this is that the intention is clear. We want this guy to take our shares, right? We want him to take our shares, and therefore we advance a loan, right, so that loan will be given to you for you to buy something which will automatically convert into shares. That to me looks like unlawful financial assistance, right? Okay. Now, it says in regard to the objective of restructuring the balance sheet, the board proposed to carry out the following transactions. Wipe out the large loss of 1 million on its balance sheet so that it can free up sufficient reserves to resume dividend payments. That you've not done, but basically what it means, you're going to do a reduction of capital, right? And when you do a reduction of capital, you will be able to wipe out your losses. That's the beauty of a reduction of capital. You wipe out your losses, then your balance sheet is clean, so any profits you make will not be weighed down by those accumulated losses, right? We'll deal with this probably, I think, next week. But the bit here, pay out immediately a scrip dividend of 1 million to its shareholders. What do you think?
I don't think it's...
Aha, good question. What is scrip dividend? That's the issue. A scrip dividend is a bonus share. It's a bonus share. Right? And they can do this. Why? we know the company has a share premium account, right, of 2 million. So if there's 2 million in the share premium account, the company can capitalize 1 million of that 2 million, right, by just taking 1 million from the share premium account, put into the called up share capital, right? So called up share capital goes to 6 million, right, from 5 million to 6 million, right? Now, if it goes from 5 million to 6 million, surely you need to give people certificates to say, hey, you now own more shares, right? Remember? Because that's the whole purpose of a bonus share. You're simply evidencing the increase in the share capital, and to make the shareholders happy, you give them this thing called a bonus share. But actually, the technical name is a capitalization issue, right? Or scrip issue. It's a capitalization issue. And obviously, the shareholders get really happy. And I remember when I was about 8, my mom always used to get excited anytime she got her bonus shares. At that point, I knew that this was something really good. Bonus shares and all that, So, but anyway. And my dad never really explained to her. There was no, because he was an accountant, so he should have been able to explain to her that there was really nothing really going on there. So anyway, but that's the point. You can capitalize. So there's no problem in paying that dividend. Many people miss this, even though I remember you kind of explain a script dividend, but because they see the word dividend, they think, maybe the company doesn't have enough profits. Now, obviously, we're not going to deal with this because this deals with debt finance, right? We're going to deal with debt finance later on. Now, notice here, it says a small minority of shareholders in Delta are opposed to most of the above transactions. What do you think when you kind of see that? What do you think it's getting at instinctively? Exactly. The power of directors to allot shares under Section 551. Remember when we talked about control of, it appears under the topic, who controls capital structure, right? And we talked about Section 551, and I said there were issues of authorization of directors, there were issues of preemption rights, because what you're doing here, right, I may be a shareholder. I may not like these 3 guys coming into the company, right? So, and if that is the case, certainly the first 2, right? The third one raises interesting issues, right? Because, it is not equity securities. Remember, we talked about preemption rights. And we said you get preemption rights, right? When there's an issuance of equity securities, right? So the third one, which is a convertible bond, which, by the way, the company is not issuing. The company is merely granting a loan, right? Do you see? So if you're analyzing this, you do not put all of them together. You take the first and second, right? I.e. the payment to the issuance of shares to Zaza and the other one, right? And so the shareholders are saying, I don't want this. Why don't they want it? Because it's going to dilute them. It's going to dilute them. So this is a contest of, who controls capital structure. And so you're entirely correct when you talk about Section 551, and that's something you need to be aware of. And then it says you've been engaged by the directors to advise them on the legality, right? So obviously some of the things we've been talking about deals with legality, then accounting treatment if relevant, which clearly we've been talking about, and mode of implementing the aforementioned transactions. So notice in this question, we get the raising of capital, we get we get restructuring, in terms of trying to wipe out your accumulated losses. We also get debt finance, we get shareholder rights. You can see how everything sort of comes together. Whereas this other question, which, don't worry, we'll take a break, but this other question is solely, I believe, on the raising of capital. Well, maybe slightly more, I think. So we'll take a 10-minute break. All right, so don't be depressed. I think people, remember, we've not dealt with debt finance yet, and we've not dealt with wiping out accumulated losses. But at least you understand the building concepts, and I think, certainly on the things we've covered, I was very happy with the answers you gave. So let's take a 10-minute break, and then we'll come back and start with Zenith.
I'm not sure why the PCP are taking
Yeah, well, because what I explained earlier, private companies, we apply easy rules to them. So think about it. We don't even regulate how much capital private companies should have. There's no minimum capital for private companies, right? I mean, obviously.
Just because of the easy rule.
Yeah, so because the idea is that, a choice was made to be soft with private companies. So, but it was good to use that example to see it in a very clear way. Otherwise, if you just read about it and say PCP, it just flies over your head. Yeah. Yeah.
L'interesse è un'entrata, si mette l'anno stato patrimoniale, si mette nel conto di... Cioè tu quando fai il bilancio hai due parti, la parte dove metti i crediti e debiti e la parte dove metti entrate e uscite, questo è elementare. Quando tu fai gli interessi che maturano negli anni, no, l'interesse è l'entrata.
We got something about the share accounting in the second page. So just about now, I got slightly confused. So the share premium account would be 20 because the past one, and obviously they are issuing the share at this price, but we are getting 33,000. So the 3,000 missing. Where do we put that?
So anything above par, everything above par goes into share premium account.
Okay, so 23 and 10.
Yeah. So here, if the shares, so remember the shares have a par value of 1 pound, right? So they're issuing 10,000.
Exactly.
Right? So that's really, it's only 10,000 that goes to the share capital account.
Yeah, okay.
Right? Then everything above.
So 23.
Yeah, exactly.
It's a very weird concept. You have a company law here in the UK. The company law in Denmark is so much cleaner. There's no... Which one? Many of them you can amend in our draft online. No. But I love it. No, I think only had steak. But I mean, they have burger everywhere in London. London is like the central hub of burgers. Yeah. Yeah, I'm talking Yankee US.
Yeah, but I think no. No, it's because the person when I already understand if you're going to run the service or you're not if you promise to be in the future, it's not limited to time. It's considered as credit or other types of I have to take from this.
That doesn't sound very standard. Get out, boy. Get out. One I talked to that's like a thousand.
But do you know if it's going to be I don't know when. I think towards the end. I think so. Yeah. Because I did recommend for it to be spaced out. Yeah, with the other sort of subjects. But they've not communicated, so I'm not sure. Right? But normally, it would be sort of towards the end. The administration should contact the administration. They should send. Yeah.
Guarda, al netto che l'abbonamento ha un costo io non lo so, secondo me non è una misura che può rilasciare il risultato posso dire che al netto di quello che succede ci sono tanti siamo anche di io sinceramente non lo
Excuse me. Hi, sorry.
Hi,
Just a
yeah.
quick question. You know, for the first part, the question about the advance of shares for the debt payments. So is that okay or not okay? I still didn't quite get it.
So
So you issue 10,000 shares at £2 each for the supplier. So is that okay or it's not okay?
yeah, so we said it was okay. So you're talking.
Convert a debt holder into an equity holder of that company.
So let me just be clear about. So we're talking about this one.
Yeah, the first one.
Yeah.
So you're converting a debt holder of a company into an equity holder of a company. Also, you don't give them the option to well, they can still receive the cash once they sell the share. But what happened? You mentioned about the liquidation. If you look at the packing orders, if they are the debt holders, they have hierarchy in terms of receiving the debt. So it's not okay, isn't it? Because the supplier is sort of worse off by receiving the shares.
Is the company worse off or the
Sorry, the supplier being the one being offered the share being worse off because their position.
Yeah. So he's happy with that.
He's happy with that.
Yeah.
Okay, it's fine. I just saw like.
No. So do you see?
I wasn't quite sure because like, if I'm the debt holder, I wouldn't be happy with it. But if he's happy with it, that's fine with me.
Well, it depends. I mean, if you're a debt holder for Facebook before it launched, I'm sure you'd be very happy for Facebook to give you shares.
Yeah.
But remember,
but they were making huge losses, right? I could be expecting the company to be liquidated, that I can receive the assets.
Yeah. Okay. But this is the law here, Section 583, right? A share in a company is being paid up in cash. If the cash transfer, then what's cash? Cash received by the company, right? A release of a liability of the company for a liquidated sum. That's the release.
Okay.
The company owes you. You release that liability. That's technically payment in cash, and you consented to it.
Okay, that's fine.
Okay.
That's fine. Okay.
Okay. Okay. So, can we start? Is everybody back? I was in a daze. I wasn't keeping an eye on the time. Are you missing anyone? Okay, so let's start. Oh dear. So here we have Zenith. So it's again, this is a private limited liability company, and it was set up by A, B, and C, and they're also directors, and ordinary and issued and preference shares were issued, and then it tells us about. Yeah, no, don't worry. All right, so we're dealing with Zenith. It's a private limited liability company, and it tells us that a key aspect of the business plan of the company was that it was going to sell its property projects, development projects, no later than the end of 18 months after the completion of the projects, and distribute the net proceeds of sale amongst the investors, regardless of whether or not a profit was made. Now, in terms of the capital structure, we know that the company has 1.4 million ordinary shares and 400,000 preference shares. It tells us about how the shares were paid for. It says it says Adam, who had difficulty raising the cash, sold a piece of paper, a one-page piece of paper to the company for £10,000. So presumably he got £10,000 back. He then handed over the £10,000. So maybe he went home for lunch and then came back and handed the £10,000 back. Although I said promptly, you know. So by so doing, it was understood that he paid cash. And then it says, aside from this cash payment, A, B, and C paid the outstanding amounts for their shares by transferring a business which they jointly owned to Zenith. Although Ben subsequently made a contribution of $100,000 to the company to ensure that it had sufficient working capital, he didn't treat it as a subscription for shares. And it tells us that the company has a substantial share premium account, and it has recently revalued the stock of its property development in line with market values and considerably above book value, thereby recognizing a substantial profit in its income statement. Now, it tells us that by Article 71 of the Articles, no member is entitled to vote if they owe money to the company, right? And then it says by Article 3B, preference shareholders are not entitled to vote unless, of course, dividends are in arrears for 6 months. So it then says that there was to be a general meeting, and there was a dispute between the ordinary and preference shareholders as to whether, as to who was entitled to vote. Preference shareholders claim that the ordinary shareholders were barred by Article 71, right, because some money is owed. On the other hand, the ordinary shareholders said the preference shareholders were barred because of Article 3B1, as there were no profits. In other words, because there were no profits, the dividends were not in arrears. And if the dividends are not in arrears, then preference shareholders don't get the right to vote. Now, the preference shareholders basically say, well, that it was within the means of the company to declare a dividend, and they've also threatened to sue for breach of contract for failure to distribute the net proceeds following the sale of the Pinnacle site. Right, so there are 2 points there. And the board has come to meet you for advice. And by the way, it tells us that Ben wants his money back. Remember, Ben gave the company some money. So the question is, how do we deal with this? Yeah.
Well, when it said that Ben made a contribution of 1,000.
No, but can I interject, if you don't mind? It's always good to be structured, to take, yeah. Otherwise, there's nothing is worse than a highly unstructured answer. You might get all the answers, but sort of. So it's always good to just look at what we've been asked. Think about it as a legal opinion, right? The board has asked you for your advice in regard to the issues, and so you want to think about everything that has happened, and then provide the advice in a structured way. Who do we start with, and why? Yeah. Who do we start with? Remember, the core of the dispute between the two groups of shareholders is about entitlement to vote. And that is predicated on allegations of non-payment in the case of the ordinary shareholders. And then in the case of preference shareholders, it's predicated on whether or not a dividend could have been paid. Right? So to that extent, the very first issue that crops up would be the payment for the shares by the first person, so Adam. Right? Adam basically sold his business plan and received £10,000 and then handed the £10,000 back. Do you think this is regarded as lawful payment for shares? What rule will apply? The law says you pay for shares in money or money's worth, right? Now, Adam is saying, actually, I paid in money, not money's worth. Because if Adam paid in money's worth, even though this company is not a PLC, to which the requirement for independent valuation would apply. So even though it's not a PLC, and therefore that rule does not apply, the common law rule established in cases like RERAG would apply. And if you remember the common law rule in RERAG, it says that if the value is colorable, if it's illusory, then the courts will not regard it as genuine payment. Remember, we talked about this a while ago. So essentially, I suppose the preference shareholders will be arguing that Adam did not pay cash. That would be the argument. They would say Adam paid by transferring a one-page document, which they believe is not valid payment because they think it's illusory, it's colorable, and therefore the case law of RERAG would apply to disqualify that payment. Therefore, Adam owes the company £10,000. Therefore, Adam doesn't get to vote. You see, that's where they're going to be going.
Could you not argue by paying 10,000, actually the company is missing the value of the paper is worth 10,000?
No. I mean, we start out by respecting the business judgment of the directors, but I don't think we should be held, hostage to that. What if the directors are bad people, greedy people, whatever? What planet are you living on? You respect everything directors say, just because directors say this, that it must be a good value, a good assessment of value.
Sorry, quick question. What's guaranteed distribution?
No, we'll come to that. Let's deal with this first point, one step at a time.
Isn't there a case for itself whether this one-page document is actually illusionary or if it's actually worth 10,000?
Yeah, that's why I mentioned the RERAG case. If you remember, I said, maybe you'll remember this, I said that way back, RERAG itself was decided in the year Salomon was decided, 1897. And I remember giving the example of Salomon. I said in Salomon, the guy sold his business in Whitechapel to the company and, placed a value on it. And the House of Lords basically said that, this was not a real value. It was, the fond expectations of a sanguine owner, right? But they let it go. But then you had RERAG decided the same year that said, well, we're not here to rubber stamp these things. If we think it's colorable, all right, if we think it's illusory, then we would regard this as a fraud on creditors. Now, so...
But it's an arguable point.
It's an arguable point.
That's why I was saying that if the company is paying 10,000 for the document, then obviously something that I could argue, well, my business is worth
Yeah.
Maybe
No,
it's
I agree. I mean, but that's why it will be attacked, isn't it? Because the reason why, the reason why they will attack it would be that the guy really has not paid for his shares, right? This is a device, right? So at the end of the day, the directors would take refuge in the business judgment rule, right? So that's really what they'll take refuge in the business judgment rule and say, as a matter of business judgment, well, we think it's valuable. So if I'm writing this advice to the board of directors, I would basically be saying, it's your business judgment at the end of the day. So we kind of come to your answer. Right? Now, then it goes on to say that so the guaranteed distribution model is simply a fancy title for a one-page document. Right? It's not terrible. There's really nothing there. Now, but do you think, by the way, he paid for cash? Because I know we're assuming he paid with a non-cash asset. But obviously, if he paid cash, then we've solved the problem. Do you think he paid cash?
No.
But he promptly handed over the money.
I would say the connection is too close of the two events.
Yeah.
It's considered paying with an item.
Yeah. So that would be a matter for the...
But it's not fair,
Yeah.
You could argue that.
Yeah. So really, at the end of the day, the courts will look through, right? They do, just like we talked about. If you remember, we've talked about this twice in the Mosley and Coffentine Mines case, where the courts basically said, well, this is immediately convertible. We have a problem with it. And then we also talked about it in the convertible securities example, when there was financial assistance to buy convertible securities, and I said that could be regarded as shares, even though technically they're not shares. So the same type of thinking. There's a case actually called Ray Bradford on your seminar sheet, which basically shows that the courts can recharacterize stuff. They can recharacterize it, right? In other words, the courts can look through and say, so that's the operative word, recharacterization. You're going to see this a lot when we do debt finance, where you draft a fixed charge and the courts basically say, no, it's not a fixed charge, it's a floating charge. So the courts are basically coming in here to say, yes, you purported to give cash, but we will characterize it as a non-cash asset because that's exactly what you did. Right? Okay? And then if it's a non-cash asset, because it's a private company, then you simply apply RERAG.
I think the last question spoke about financial systems. This characterises financial systems. I mean, if for example, the one-page document is worth nothing, and they're using that to disguise the payment of 10,000.
That's a very good point. Really good point. That is the company. Did you get the point he made? That is the company providing financial assistance for the purchase of its shares. That point hasn't been dealt with, on the face of it, I don't see why not, right? But I think if you look at the way the rules are structured, I think I can't remember what the provision is, but there is a possibility to argue that the rules on financial assistance do not apply in this context, right? But it's not very clear. So I think the argument is a strong one to say you're actually receiving financial assistance. And that takes me back to the point I made earlier when I said, if you're doing deals, you need to always have it on your checklist, because sometimes it's not obvious. And if you just have it there, then you sort of think about it and say, is there financial assistance? Okay. Then here it then says that then it says ABC paid outstanding amounts by transferring their business, right? By transferring their business to the company, which they jointly owned. And is there a problem with that? Is there a problem? So they're paying for their shares by transferring outstanding amounts. So by transferring a business which they owned to Zenith. Is there a problem with that? Because remember, the preference shareholders are saying they've not paid. What do you think? Do you think there's a problem? There's no problem. Why should there be a problem? You can pay for shares with a non-cash asset, and it's a private company. This is similar to what Salomon did in Salomon and Salomon. What's the problem?
The valuation of the business.
Because it's not a public company. If it's a public company, then you need to get independent valuation. All right? Okay. And then it tells us that the company has a big profit on its income statement, and preferential dividend preference shareholders have seen their dividends in arrears. So they're basically saying that because we have these profits, and you could have paid a dividend, right? And you've not paid, our dividends are in arrears. And if our dividends are in arrears, then we have voting rights. So that's the first argument. The second argument is that you actually entered into a contract to sell the Pinnacle site. And if you did, 18 months after the development, you would have had money. And because you've not done that to pay our dividends, then we have voting rights. What do you think? What would your opinion be to the directors? Do the preference shareholders have voting rights? Is it a strong argument? So remember here, the preference shareholders. So we have this bit here, which says a key aspect of the business plan was that it would sell its property projects no later than the end of a period of 18 months after the completion, and distribute the net proceeds of sale amongst the investors, right? And then, so that's point number one. Point number two, Zenith has a substantial share premium account and has recently revalued the stock of its property developments, right? Thereby recognizing a substantial profit in its income statement, right? So now the preference shareholders are saying that the preference shareholders here are saying that a dividend should have been paid, that it was within the means of the company to declare a dividend. They've also threatened to sue for breach of contract for failure to distribute the net proceeds of sale arising from the sale of the Pinnacle site. So my question to you is, do the preference shareholders have an argument here? Yeah?
I'll probably say that the value going up is just on the books and it's not realized profits.
Yeah.
It needs to be realized profits for dividend, and therefore they don't have an argument.
Yeah, and not only that, so in fact, 2 points there. One, the agreement to sell the site and pay a dividend, whether or not they made a profit. Remember, that's what it says. Whether or not they made a profit, that's not enforceable. That's not enforceable, right? You remember at the beginning it says to sell your property developments 18 months after, whether or not you make a profit, and then distribute it. That runs counter to the rule, right, on capital maintenance. That's number one. Number two, as you said, they revalued, created a paper profit, no realized profit, right? So no dividend was paid. No dividend could be paid, right? So yes, the dividends are in arrears, right? The dividends are in arrears, but you can't force them to pay a dividend. Now, if the dividends are in arrears, then surely the preference shareholders have a right to vote. don't they? Do you get it? Do you get this point? So, whether or not the preference shareholders get money is a separate issue to whether or not they can vote. They actually have voting rights precisely because they've not received money, right? So they have voting rights when the company does not pay a dividend. So if the company has not paid a dividend, then surely they should be able to exercise voting rights. But what they cannot do is sue for a failure to pay a dividend, or indeed sue for a breach of the Pinnacle site agreement. Do you get it?
What are the arrears then?
Sorry?
The arrears.
So because if the dividends have not been paid, then right, then it means your preferential dividend, because you'd have a dividend right for every year,
Yeah.
right? Now, and it's not been paid.
So it's not, even if the company doesn't have profits to pay the dividends, you still have a right to dividend that accumulates.
No. Let me clarify that very quickly. So if you bargain for cumulative rights, then it will carry over.
Yeah.
They didn't bargain for that.
Yeah.
All they did was to say, our shares will have voting rights if our dividends are in arrears. In other words, they're saying, we're prepared not to vote in a company because each year we're getting 10%, right? So we don't need to vote. But once you're no longer able to give us 10%,
Because you have profits to pay.
because you're so useless in your management, and therefore you don't have profits to pay, then now we get the right to vote so that we can take control of your management and make sure you make a profit.
So it doesn't mean that there's profits, but they don't want to pay you the dividend. It just means that you have a right to dividend and they're not paying.
Yes. So whether or not, so what the preference shareholders cannot do, because what the preference shareholders want to do here is compel the money, right? To say you should have sold the Pinnacle site. The reason why that question is there is to test your understanding of contract and the fundamental rules of common law. Now we're saying you can't do that. You can't force them to pay, right? But one thing we can do is honor the agreement you entered into, which is that your shares become enfranchised when dividends have not been paid. Why the dividends have not been paid is neither here nor there, right? And so I think that's sorry. Yeah, please. Yeah.
How long will those voting rights last for?
Until yeah. That's, if you look at the standard articles, it's always like that. That whenever preferential dividends are in arrears, they will have voting rights, and then once you start resuming, then it comes back. So it's I'm just making sure I've not missed. Yeah. So that's essentially it, and it's really important that there are many ways we can test contract, right? That is parasitic on this kind of structure. I'll give you one example. You better remember this. Where, what if I take redeemable preference shares, right? I take redeemable preference shares, and then I say that I want you to provide security that you will redeem the preference shares, right? So I want you to pay money or to devote an asset somewhere, right, to guarantee, to secure this redemption. Now, we then get to a point where the company cannot redeem because they don't have available profits. I then say, well, I want to enforce that security, right? Now, this is a life issue in practice. It's not going to fly, right? If the company does not have distributable profits, then you cannot use contract as a way around it. So whether it's a security, whether it is this agreement in regard to the Pinnacle site, it just won't fly. Okay. So does anybody have any questions?
Just
be a normal exam paper?
Sorry?
Would this be a normal exam paper?
Yeah.
And how many of them are we getting? Just one or two?
Oh, and the questions? Yeah.
Is it just one paper?
No. You get like this. You get, I think, 6 questions, and you answer 2. Two out of 6. That's what we call the French call an embarrassment of riches. So you're spoiled for choice. And you're not restricted. You're not restricted in how you answer. But in my experience, people always go for, well, not people always. A lot of people go for the problem questions.
Do you have the same length, same content?
Sometimes it varies, It depends
just
on the
open questions.
Yeah.
Open questions or just problem solving?
No, a combination. So you have, so you probably have like 3 problem questions, 3 essay questions, right? 3 problem questions, 3 essay questions, and yeah, and but generally speaking, in my experience, people, they do very well. And I mean, look, you guys were already on ball, and you're on top of it.
Do they carry equal marks?
Yeah, they all carry equal marks. And they carry equal, and we don't prioritize. We don't value one type of question over the other. Right. No, if